Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong. She is a great educator as well, and she's going to be here to help answer your questions and facilitate that conversation. So if you're here in the live version, thanks for joining us and welcome to all of you. If you're here in the recorded version, thank you for being there as well. Be a part of that conversation by leaving us a comment in the comment section. We'll reply to that as quickly as we can. So we're glad to have you on board with this this morning, taking a look at long vertical spreads and long diagonals. One of the topics, and this is a particular strategy that we talk about in our advanced options live workshop. We've got one coming up in New York in a couple of weeks. And it's also something to talk about in our advanced options virtual workshop. One of those we've got coming up next week. So I'll talk about those as we get into this discussion. But it is a strategy that I think is particularly topical today, given the fact that volatility is relatively low if we take a look at the market as a whole. So we're going to talk about that today. We're going to talk about the possibility of movement because it is a directional strategy, to be sure. We'll get into that here as we start this discussion. Remember, though, a couple of quick housekeeping items. Everything we talk about is simply for illustrative and educational purposes only. Not any kind of a recommendation about a security or strategy or account type or anything else. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you are aware of and understand and have read the characteristics and risks of standardized options before considering any options transaction. Now, when we talk about long options, which are the drivers of long vertical spreads and long diagonals, with those long options, an investor may lose 100% of the funds invested in the trade. So just be aware of that. Now, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of the platform. It's a great learning environment. However, it doesn't do certain things that a live trading account will do. One of those is it doesn't fill orders at anything but typically the midpoint between the bid and the ask, whereas a live account's going to fill based on market forces, which may not be the midpoint between the bid and the ask. Second, one of the things that the paper money account does not do is it does not facilitate the early assignment of short options. And since we're talking about spread trades, a spread trade typically has a long leg and a short leg. And so there is the possibility that a trader could be assigned on the short leg. Now, in long verticals and long diagonals, oftentimes that may put us in a situation where we achieve maximum theoretical gain or close to maximum theoretical gain. Doesn't always. We'll talk about that as we get into this discussion about the possibility of early assignment. So be aware of that. Also, remember that investing involves risk, including the loss of principal. And for some products and strategies, loss more than your initial investment. So that is a possibility as well. Past performance, of course, no guarantee of future results. Let's jump out to the Thinkorswim desktop software platform, take a look at what's going on. Because the market just a moment ago, as I was watching, and now has maybe retreated a little bit. Market, as defined here by the S&P 500, was hitting a new all-time high at just above the 7,800 level, breaking out to that level. So there is some directionality of movement to the market today, the market moving a bit higher. It's backed off just a little bit from that high. If it closes there, then everybody on the floor of the NYSE gets a new hat that says 7,800, which would be nice. Doesn't mean that it's going to continue higher, doesn't mean that it's too high. It just is what it is at the moment. And we're starting to see some breakout movement here. Starting to see the NASDAQ moving to the 30,000 mark, just above that 30,000 mark at 30,094. Also, not a new high, but also a new kind of weekly, maybe even a monthly high. We haven't been back up here since the June timeframe. May-June timeframe is when we were back up in this range. So not at a new all-time high yet on the NASDAQ. Russell 2000 at a new high, moving here to 3057 and maybe 31, the next magnet level of potential resistance, but that breakout of that symmetrical triangle on the Russell 2000. So small caps moving higher as well. Now, corresponding with all of this with those moves to the new highs. I'm just going to pop over here to our VIX grid. This is the volatility index. This is the VIX of the aggregate market, and we were at the 1458 handle yesterday. We're kind of sitting at the 1458 handle today. That suggests that there's not a lot of volatility overall. The volatility of individual components, if we were to look at VIX, say for instance, the VIX 1 day, that VIX 1 day down a little bit lower here, the VIX 1 day sitting at currently 7.35. It started the day down in the six handle, in the high six handle. So not a lot of market movement here in the overall VIX. If we take a look at the VIX in general, and we take a look at the VIX relative to the VIX EQ. So this is the volatility of the individual components of the S&P 500, not just the aggregate for the SPX, but each individual VIX or each individual implied volatility number. That suggests that VIX EQ, the individual volatilities, are also significantly lower than they were just a couple of weeks ago. Now, here's the problem with low volatility. The low volatility begets higher volatility. It's not a direct correlation. Just because the VIX is low, right? Just because the VIX is down in that 14 handle and it hasn't been there since January, does not mean that the market is going to turn around and go the other direction. We look at the VIX compared to the SPX, and you can kind of see that disparity going on, that dispersion. So SPX is moving higher, VIX is moving lower. There is this inverse relationship that when the market moves down, the VIX moves up. There's that fear that bleeds in, and investors are willing to pay more for protection by buying, say, for instance, SPX options. So I'm just going to say this, it's not because the VIX is low that the market might move to the downside. But here's the idea that because protection is cheap, meaning the SPX options that drive the VIX and individual VIX, as we saw in the VIX EQ, those volatilities are low. That has a tendency to beget a spike higher if something scares the market on an individual basis, on an overall market basis. But we've got relatively cool CPI and PPI prints, so we don't have a lot of inflation going into the mix at the moment. We're the majority of the way through earnings season, so there's not a lot of earnings-driven surprise potential out there. And so this is an area where the VIX may continue to grind a little bit lower. But individually, we still have a couple of big earnings announcements to come. And if there are surprises, that can drive a rise in the VIX. Now, for a long options trader, and the reason that we're spending a little bit of time talking about the VIX and the way that the VIX is relating to what the market is doing, is on an individual basis, if there is news to surprise the market because of an earnings announcement, volatility can go, which has been relatively low, can go fairly high, and it can go high quickly. So the one example that I want to look at here really quickly to start this discussion, I'm going to pop over here to my single grid, is one that many traders are probably familiar with. Let me clear this out from what I was looking at earlier, and let's look at this one, NVDA. Some of you are probably familiar with this particular name. I'm going to take some of these lines off. I'm just going to do this. I'm going to clear this drawing set so that we've got kind of a clean board. Now, I've got RSI on here. I'm going to put implied volatility as a study on this particular chart. And the reason that this matters is because implied volatility relative to an earnings announcement, which we've got coming up on the 26th of August, so a little more than 10 days away. By the way, that's just going to be right ahead of that advanced options workshop in New York, where we would love to see you. I'll show you the information for that here in just a minute. But notice where implied volatility is relative to where it has been. Implied volatility for NVIDIA, not the lowest it's ever been, but it's pretty darn low relative to where it's been, and it's been falling a little bit. So for a long options trader that's looking at taking advantage of upward movement, because there is, I think, some directionality here. You're starting to see NVIDIA maybe breaking out of this kind of, I'll do this as a Rachel Deshelle inspired cup and handle, because she and I talked about this the other day when we were in, where were we? Orlando. We were in Orlando doing a workshop, talking about this being a potential cup and handle breakout here. So there is some directional potential, and that directional potential maybe even back up to this next level of resistance back around that previous high. So low implied volatility with directional potential begets the idea of a long option trade, perhaps taking advantage of that directional movement in a leveraged way. But it could be expensive, number one. And number two, if implied volatility goes down, that even more, that works against you. But we're not necessarily buying an overly inflated option here, generally. So what I want to do is, before we even get into this trade and kind of the directional nature of it, I want to pop over here to the trade tab for NVIDIA. I'm going to scroll down in this list to today's option statistics. And I don't know how many of you use this particular uh, set of data, but it gives us a couple of quick and easy data points that can be used, especially for long vertical spreads. One of those is where implied volatility is currently. Right? Currently at 42%. Now, if I didn't have any context, I wouldn't know that 42% was high or low for NVIDIA. I would judge that at 42% implied volatility could be kind of middle of the road, but I don't have any historical context unless I look deeper, unless I look at where the 52-week high for volatility is up around the 60th percentile, and the 52-week low for implied volatility is down around the 30th percentile. That gives me my current implied volatility percentile of about 38%, or about the 30th percentile. That's below the 50th percentile. So this is relatively low, and as we saw in the chart, potentially rising, benefiting a long option trader. Right? But that's only one aspect to this trade, is that possibility in a rising implied volatility. So that would be nice if all we had to do was focus on implied volatility. But this gives us kind of that go ahead, if you will, not permission necessarily, not go ahead, not a preference, but it's simply saying, look, implied volatility is relatively low and rising. If there is directional movement, or if there is news, the market, that implied volatility could rise. Now, here's the other thing to think about this. We're looking at this as the potential for a bullish directional trade. If NVIDIA moves in a bullish direction, what's the likelihood of a rising implied volatility number? Because generally when the market moves up, or when an individual stock moves up, volatility falls. It tends to drop. That's just the nature of volatility. But we're doing this against the backdrop of this earnings announcement, which is likely to bring implied volatility higher. I may not want to be in this trade all the way until that 8/26 expiration, or that 8/26 earnings announcement, but I may want to profit from that rise in implied volatility and seeing what kind of directional movement we could get within that time frame. So rather than turning this into a longer term, maybe long call trade, I'm going to use some of the nature of what I know about long vertical spreads to maybe trade this in a shorter time frame, expecting some directional movement if we get the breakout, but not holding it through the earnings announcement, but benefiting from the potential for a rise in implied volatility going into the earnings announcement, which this stock typically tends to do relatively late. You can see that if we go back, almost a year ago, implied volatility was still rising into the announcement. It's been rising into the announcement. Now, we had one earnings announcement here. We look at the last one where implied volatility peaked maybe a week or so prior to the earnings announcement. But we're just starting to see implied volatility here kind of holding its own and maybe rising a little bit on this breakout. So going into the earnings announcement, we're a couple of weeks away. That gives me the potential for a short-term long vertical spread with some bullish directionality. And as Ricebird says, yeah, in the moving business, not the storage business. I like that. You're stealing my line, which I stole, which Barb stole. I mean that's where we do this, right? All right. So what I'm going to do is I'm going to pop over here to the option chain for NVIDIA. And look, this is a very liquid traded underlying stock. It's got fairly liquid options. I'm not going to be terribly worried, especially as we get closer to expiration, about trade liquidity in this particular case. I am going to double check the width of the bid-ask spreads. But I know by looking at where implied volatility is highest in this option chain over on the right-hand side, that the 28 AUG expiration is very likely going to hold the earnings announcement. And that's 15 days to go until expiration. So I may trade it in that 15 or that 28 AUG expiration. I may trade it in the 24 August expiration so that we're done with the trade prior to the earnings announcement. That has also relatively low implied volatility right now, which would benefit us because then we would be buying a relatively inexpensive, from an implied volatility standpoint, long option. The problem is we might be trading a relatively inexpensive short option against it as well. So we got to take a look at that. Now, the other thing to think about is this. $10 implied move based on the current level of implied volatility, $10 potential move. So let's go back to our chart. Here's our breakout level at about 224, and here's our target up here about 234 or 235. So that's right around that expected move in terms of that directionality. I like the symmetry of that, the fact that if we get this breakout move at 225, the target is up around 235. That's about a 10-point move. Cool. All right, so that's gonna kind of center me now on this 24 AUG expiration. I'm gonna open this up and we're gonna look. I don't need 150 strikes. I was teaching the index options webcast there yesterday when I was doing SPX options and I needed 150 strikes. I'm gonna do 40 strikes. So I already have my expectation based on technical analysis and that expected move. I know where the price of the stock is right now. It's about 225. So here's my thought process on trading long vertical spreads. Buy the long leg where the price of the stock is now and sell the short leg where the price of the stock is likely to go or where I think it's going to go. I don't know for sure where it's going to go. So what I would be looking at then here would be maybe going long, and these are 10-cent wide bid-ask spreads, 5-cent wide bid-ask spreads, kind of bouncing back and forth, right? Remember what I said about this being a very liquidly traded option? Generally, doesn't guarantee anything, but it tells me that that's going to be something that I need to pay attention to. So here's the other thing I'm going to do. I'm going to change this layout from delta gamma theta, or delta gamma theta. I'm going to change this to delta theta vega instead. I'm not terribly worried about gamma. I wouldn't be terribly worried about gamma until we get close to expiration, if we were looking at holding this all the way until expiration, which we're probably not, and then it becomes an issue. If you want a little bit more deep dive about gamma, check out my Trader Talk or my index options webcast yesterday afternoon, where we took a really deep dive into gamma and its impact as you get close to expiration. But what I'm going to do is I'm going to look at buying this 225 long call, about a 10-cent wide bid-ask spread, which is kind of cool. 5-cent wide bid-ask spread. It's kind of bouncing back around. And I'm going to look at buying that one, and then I'm going to look at selling where I think the price of the stock is going to go. So I'm going to buy the 225, and I'm going to sell the 235 in creating this trade. So let's just kind of look at the Greeks here real quick to see how this is lining itself up. So my 225 strike has got a 51-cent delta. So it's the coin toss at this point. It could go up, it could go down. Typically, your at the money strike is going to have delta right around 50. My short leg has about half of that directionality to it. So I'm going to peel off about half of my directionality. I'm going to be left with about 28 cents of implied of directional sensitivity, left with about 26 cents positive delta. which is cool. That still is a directionally positive trade. This is still a trade that's going to require directional movement. Now, if I look at time decay on that long leg is going to hurt me. Time decay on the short leg is going to help me. And it's going to help by more than about half of my long theta. So I've cut that theta decay down quite a bit. It's not going to be as big a factor. Still going to be a factor, right? Now, talking about implied volatility changes. So I've got 16 cents of long Vega, and I'm going to have 12 cents of short Vega. That means I'm going to be left with about 4 cents of long Vega. If implied volatility goes up, then cool, that's great. That's going to benefit my long leg. Ideally, that is what might happen. But if it doesn't, if it stays the same, or if it starts to go down, that's still, if we get a directional price movement to the upside, that's going to be the bigger driver in this particular trade. So while we look at implied volatility as one of the components for a long vertical spread, it is not the only component, and it oftentimes is not the biggest driver, but we kind of lean on that from that perspective of saying that long vertical spreads maybe work better when implied volatility is low and rising, and that's kind of the situation that we're in at the moment. So let's do this. Let's kill those annotations. Let's come back over here and let's put this trade together. So we're going to buy the 225. I'm just using my control key here, and I'm going to sell the 235. And I'm going to create this this $10 wide vertical spread for a net debit of about 340. That's not very much. I mean, it's still relatively elevated because these are expensive options. This is a $300 stock, $200 stock, right? So that's still going to be relatively expensive. But you think about it, what that means is $3.38 net debit against the $10 wide spread means that I've got a max profit potential in this trade of about $662. Now, let's talk about that probability of success. This is not a high probability trade. This is different than a short vertical spread. This is different than selling a short put vertical. Same directional bias, but it is a different animal because this requires directional movement and it has a different set of probabilities. The probability here gets a little bit turned around. So if you think about what our net delta is on this trade, remember we were left with about 24 cents. Actually, I'm sorry, about 27 cents of net positive delta. Equate that to the probability, right? Now you can use the short leg as the probability of ultimate success. That's about a 22-cent delta, which means it's got about a 22% probability of being in the money to expiration. I'm going to take maybe the little bit higher side of that because there is the trend moving in this direction, and go with about that 27% probability. So you think about that from that standpoint. That's about a 1/3 probability of success, 2/3 probability it doesn't get there. Now we could use probability of touching, and I know Barb's talked a lot about probability of touching. Connie's talked a lot about probability of touching as an expression of, is it going to get to that point? And it could. But, here's the thing. I don't know that I'm going to get that max theoretical gain out of this trade. I might get the max theoretical gain out of this trade. Max theoretical gain in this case is 662. So two things to think about when we're putting on a long vertical spread. One is we may take the trade off. If it's done, the majority of the work that it can do, right? If it does that, great, take the trade off. The problem is this may pay us a little bit later, right? Because, well, maybe not, because we're pretty close to expiration here in this particular case. We've got 11 days to go until expiration, so we're a little bit shorter term. So the resultant decay of any remaining extrinsic value, I don't know, we may be suffering from that, right? We're maybe kind of getting the most that we're going to get out of that. But if we do get that directional move, it is entirely possible. And here's the other side of the coin too, is that if for some reason, now it's not a high probability scenario, but if for some reason somebody were to assign us on that 235 short call, which is not likely, then this trade goes to theoretical maximum gain, or pretty close to theoretical maximum gain. So we're going to look at this from a directional standpoint. I'm going to put this in our long options group just to make sure that that's where we're kind of keeping it here. And you're right, the 235 is an 80% probability of being out of money. You're right, absolutely. Seems a little bit high, but it is the expected move based on implied volatility. So which one do you follow? Right? Do you follow that probability number? Do you follow the expected move? And I will say this, look, this expected move based on implied volatility is oftentimes somewhat over exuberant. It often estimates more of a move than ultimately is realized by maybe 2 or 3%, but we're still going to likely get into that range. On the other hand, it could also go down. And it could also go down by 10 points, in which case we know what our max theoretical loss is in the trade because we've got that max loss. This is a risk-defined trade. I'm not going to put a stop loss on this because of that intraday volatility. I'm going to go ahead and send this order off and kind of see if we can get into this. 338. Let's edit this and see where we are now at the moment. 329. This has been floating. I didn't lock that. This is, again, paper money. It's likely to fill at that midpoint. If this were a live trade, very likely I would try to work this order a little bit and maybe work that down a little bit below that mid and see if I could get it for a little bit cheaper. Maybe see if I could get it for 330 and see if the market moves to me. Because oftentimes it will move away and then come back in and fill the order. So you just have to be patient in working that order. Notice that it just moved down to 330. So let's see if we can get it for 330. I'm going to put this in my long options group and click on send. And we'll fire that order off and wait for that market to move on us a little bit. Might not. We might have to bump it a little bit in the monitor tab to see if we can get down to that price. But that's kind of what we do with this long vertical spread. And the expectation is if this moves, then that's what we're looking for. All right. So if we were to put this in the Analyze tab, let's do this. I'm just going to recreate that order. I've got it working. I'm just going to recreate this order really quick. And we're going to sell that 235. I'm going to right click and we're going to send this to the Analyze tab. And I'm going to do this, hide positions. So there is let me float this a little bit and kind of squish this. There we go. It sold for us at the moment. All right. And I'm going to stretch this out, stretch it out a little bit. That's the cool thing that we can do here. Now, we've got to overcome the cost of the trade. So let's put this on our break even. So our cost of the trade, the break even is about 228. Price of the stock's not there yet. So it's got to see some directional movement in order for us to at least break even in the trade. We got to see at least that $3 of movement to the upside. That's where our break even point is. Here's where the price of the stock is now. But if we look at our price slices here and we look at this trade, we're left with now about 29 cents of net delta. So this is a directionally long trade. I mean, it is a directionally sensitive trade still. Data's working against us, but not very much. Vega's still positive. Vega's working for us. So if implied volatility does rise, that's working in our favor here at this point. So that's kind of where we are set at the moment. Especially if we get that move to the upside, at least to that break-even point. So that order has filled for us. And so that is a directionally biased, low and rising implied volatility into an earnings announcement, long vertical spread. Now, the intent is this, to close this trade down prior to that earnings announcement, because that's when these are going to expire. It's going to be done before we get to that earnings announcement. So before we would maybe run that risk of having implied volatility run up into the earnings announcement and then crush and holding on to the trade and thinking, I'm just going to get one more day of potential gain out of it. So that's one possibility as we look at this type of trade, is that NVIDIA trade. There's another in this mix that I wanted to look at that's kind of doing the same thing, and that is NFLX. Now, there's a little bit of a different perspective here, because from a directional standpoint, I could go one of two directions. I could make a pretty decent argument technically for this to maybe be a bounce down and a bearish long vertical spread in this particular case. But you're starting to see some increasing momentum as this is moving to the upside. We're seeing roughly equal highs on the RSI. It's running into that resistance level that it's tested before, and backing down just a little bit. But we had this gap up, and we've got low and rising potential implied volatility. And that implied volatility is essentially near the lowest point that it's been. If we go back to the trade tab here, and we look at today's option statistics, we see that that current level of implied volatility puts it at the 31st percentile. So it's low and potentially rising. I think also that there is quite a bit of bullish skew here. Taking a look at today's trading activity, there's a lot more call trading volume than there is put trading volume. The call sizzle is about double the put sizzle. The put call ratio is 0.25, which means that, again, we're at about a little over 2 times the call volume than we are in the put volume. And if I look at where those trades are going off, look at where the majority, either at the or between the market or at the ask. And that's about equal. Not very many going off at the bid. So these aren't call sells. These aren't traders that are selling calls necessarily. Again, this is not a guarantee, but this is the inference from this, that if you've got most of the trades going off at the ask or mid, that's going to be generally a bullish skew, because that suggests that buyers are willing to step in and buy calls to take advantage and speculate on that upside movement. And buying calls when implied volatility is low, they're relatively cheap. So it's cheaper here in this particular case to speculate by buying a long call than it is perhaps to try to harvest some premium by selling a short put spread. And again, the difference between selling the short put spread is nothing has to happen, depending on how you structure that short put spread. In this case, if we're buying a long call or buying a long call vertical, we got to see some directional movement. So again, buy where the stock is and sell where the stock is likely to go, or where you think the stock is likely to go. So let's go back to the technicals and look at that. Low and rising implied volatility, most of the trades going off, bullish skew. That's going to lead us to that idea. Yeah, Beauty, we don't have a price target. We expect that it's going to go up to that 235, and look at taking it through perhaps close to expiration. Look at getting out when we get close to expiration with the majority that we can get in. If it moves directionally, it moves directionally. We'll look at taking that trade off at max gain. We're close to maybe 85% of max gain in this particular case. Let's go back to the chart though on this, and let's see where we have a technical expectation. So resistance level is up here at about 77. I've got another resistance up here at around 82. And it would seem likely that if we do get that breakout of this horizontal resistance level that's been tested once, twice, and 3 times, and it was a support level back here, we got once, twice, 3 times the resistance. If it breaks out of that resistance with some good, strong momentum, that a move to 82 is probably pretty reasonable. So that's 4 points to the upside. Let's see if the options market agrees with us. Now, I don't have an earnings announcement in the front, so I don't have to worry about that. So here's the thing. The possibility of implied volatility going up is probably less, because I don't have an earnings announcement that is driving that implied volatility rising. If implied volatility goes up, it's probably going to be a function of price going down, which is just the nature of things. So I don't necessarily need to worry that much about implied volatility and about that Vega number, especially if I were to do this closer to expiration. But we might take this from a slightly longer perspective, because it might take a few days to get through that resistance level. We might go sideways, as we've done before. So I'm going to go to the trade tab. We'll look and see how we might put this trade together. So I might go out a little bit longer. I'm going to go now, I think maybe to the 18 SEP expiration for this trade, because that gives me, if assuming that the market is over exuberant, that gives me about a 2-point cushion to the upside in terms of expected movement on my price target. Price target's 82. That gives me a price target, an expected move from where the stock is now out to about, well, uh, what is that? 76 plus 6 is about 82? No, that's not right, is it? It's too early in the morning for math. I've been up too long to do math. 76 plus 6, 82. There you go, right there. 82. Exactly. I knew it. See? I was doing it inherently in my head. All right. So that gives us kind of the expectation. We're going to come back here again, price of the stock, and this is the easy kind of the bullet point structure, if you will, for a long vertical spread. Think about buying the long leg where the price of the stock is now and selling where you think the price of the stock is going. It doesn't mean that it's the only way, but that's a good starting point. So I'm going to come down here where the price of the stock is, currently about 76.80. Now, here's the kind of cool thing. We've got some granularity here. We've got $1 wide increments between our strike prices. So realistically, the mathematically correct at the money strike is the 77 strike. It's going to be a little bit less expensive to buy that. It's going to have a little bit lower directionality though, because it's got the lower delta by about 4 or 5 deltas. So what I might do is look at both of these. Tighter bid-ask spread slightly, well, yeah, slightly tighter, 10-cent wide at the 77 strike. So this is a little more aggressive. We could go a little less aggressive by going a little bit deeper in the money. It's going to cost us more. So here's what I'm going to do. I'm going to go to the 77. I'm going to look at buying the 77, and I'm going to sell the 82. Here we go. There's our spread, right? That's a 5-point wide spread between the bid and the ask, or excuse me, between the short and the long, and I'm paying $1.77 for it. So $1.77 against a 5-point wide spread means that my max profit in this case is $3 or $3.23 or 323 bucks. Again, it's got a better reward than it does risk, and I'm willing to accept that potential risk, but it's got to see movement in this particular trade. So let's just look at our net Greeks here for just a second so that we can kind of make sure this is in fact what we want to do. Maybe we need to adjust this. So long deltas of 53, short deltas of 29. So we're going to be left with a little bit less directionality than in the other trade. If we were to go a little bit deeper in the money, if I were to go to the 76 or the 75, I'm going to be left with a little bit more directionality, but it's going to be a little bit more expensive. So my gain is going to be curtailed somewhat. Theta becomes really a non-issue because I've got negative theta of 5 cents, positive theta, or how it's working for me, of 4 cents. So I'm left with a negative 1 cent theta. Okay, great. I'm in this for 36 days. It's likely to make that move before then, but I'm not going to suffer too terribly from that time decay. And I'm left with about 2 cents of positive theta, or excuse me, positive vega, which if implied volatility does go up, yeah, the one possibility is if implied volatility goes down, that's probably hurting me a little bit more than theta. And so I might look at taking the trade off if we start to see implied volatility going lower. Remember where we are on the overall VIX. If overall VIX goes up, because something spooks the market, that's likely to extend to individual names within the market as well, and we're likely to see a rise in implied volatility because the VIX is the aggregate. Individually, that implied volatility is low as well and could rise. So that's kind of where we are in this particular trade. So here's we've got our net Greeks in hand. Let's close that down. Let's go to whoops, I got to change my annotation tool. We're going to come back over here to our order entry tools. There's our trade. Right click. We're going to send this to the analyze tab. And I've got a couple of others in there. I'm going to take them out of this mix. There is our vertical spread. Let me squish this back together. So expiration on this is the 18th of September. That's our expected range, that shaded range right there. And we kind of float this around so that we can see it. So let's do this. Let's set slices to break even at expiration. There's our break even. It's got to go to 78. It's almost there. I mean, it doesn't have to move that far. to overcome this, buck 79 to overcome where that is. Here's our slice right here where the price of the stock is currently. And that's left with 22 cents in net delta. Gamma is, well, gamma is actually increasing. I mean, this is interesting because we got a fairly high gamma in this particular case, unusually so. But again, I think that may be a function simply of where that long strike is, because it's sitting right at the money strike. Typically, gamma is not going to be that high. Theta is working against us. Vega is working for us if implied volatility goes up. That's right now. If we kind of advance that forward, there is that possibility that theta may, in fact, because at the money strike, that long theta is going to start working harder. If we get a move quickly, though, that means our short strike is going to be closer to the at the money, which means that theta is not going to be as high. So, this is a trade that maybe directionally works if that price of the stock continues to move higher, but it also kind of mitigates some of these other factors that we might be concerned with. So we're going to go ahead and we're put this trade on. I'm going to pop back over here to my order entry tools. We're going to make sure that we maybe work that down a little bit. We're right at the midpoint. We might work that down to buck 78 and see if we get it. Click on confirm and send. Buck 78 against 322. About a 2-to-1 reward or risk to reward in this particular case. Lower probability. And again, we got to get through that resistance, but boy, it presents us with that possibility of a relatively inexpensive long vertical ahead of that movement. And look, we got a little bit better price on it. That price moved a bit, and that's kind of that intraday volatility. So it's generally a good idea when you're putting trades on like this, long vertical spreads, option trades in general, try to work that order a little bit, work it below that midpoint. If you're buying it, work it above the midpoint if you're selling it and see if the market will come to you. Be patient. Don't chase it, but be a little bit patient putting that trade on. So that's kind of what we've done here. Now, I promised that I was going to show you where to find some of these other resources. So first of all, coming up next week, we've got the Advanced Option Strategies Virtual Workshop. Long vertical spreads, long diagonals are two of the strategies that we talk about. If you want to join us for this is an hour and a half, Monday, Tuesday, Wednesday, Thursday. It is free to attend. It's virtual. And we talk about long verticals if I remember correctly, we talk about long verticals in let me show you the agenda for this. I'm pretty sure we talk about long verticals first. Yep, long vertical spreads is night number 1. And then we get into iron condors. We talk about some other strategies. But long vertical spreads and by extension kind of turning into long diagonals, that's the first strategy. And then if you want to join us for an in-person event coming up in a little over a week, so just a couple of days past that expiration for the NVIDIA trade that we were looking at, we're going to be in New York talking advanced option strategies on Friday and Saturday. Love to have you there with me. I'm going to be there. Kevin Hinks is going to be there. I don't know that Barb is going to be there. You're not going to be there because I don't think you were planning on that. But that's going to be a fun workshop. And then we're going to be doing that one again in Chicago in November. So we'd love to have you there in Chicago. And then if you want to learn a little bit more about long verticals, come over here to the webcast page, click on subscribe when you get here, and just type in long verticals. And you're going to get to the long verticals and diagonals playlist that Connie's been teaching, but you're also going to get Cameron talking about building a long vertical spread, Brent talking about long verticals, Cameron, Barb talking about long verticals, I'm talking about long verticals. So a lot of different reasons why we might use long vertical spreads, but a lot of different ways that we can approach this particular very flexible strategy. Guys, thanks very much for being here. Thanks to Barb Armstrong for helping out. My thanks to our great production staff and our reviewers. And most of all, thank you to you for having good conversation and good questions in this discussion. We'll see you again very soon. Take care, everybody. Bye-bye.